tick over the. Yep. All right, let's do it. Thank you everybody for joining us once again for a co-branded event between Gust and Vouch. Vouch is Gust's insurance partner, has been for some years now, and we try to get at least one of these done every quarter because it might not be the most exciting topic to talk about when you're building a high growth company or trying to tackle all the challenges that you encounter as a founder or founding team member. It's always good every once in a while to take a pause and be sure that if you've created something great, some random ass catastrophe can't completely blow it all away. And that's exactly what business insurance is about. I love this event because it's a 101 level event, but it really paints a landscape for the things you should be thinking about and when you should be thinking about them. I think a lot of times founders just don't get enough roadmaps put in front of them because they don't have massive teams to do it. There's not a lot of industry, like reference to make. If you're in a innovative or a new industry, there's not even a lot of prior art sometimes to look at. But there are just some fundamentals that, most founders should look at. And I'd advise you're roughly probably on a quarterly basis, just reassess with your, leadership team, even if that's just you wearing all the hats to be like, hey, what have I done? And is there some insurances that I should actually consider so that all my blood, sweat, and tears are not wasted when some random thing happens outside of my control? Because random things will happen that are outside of your control, more so in a startup than most industries or most businesses. So I'm joined by Sebastian and Devin from the Vouch team today. Devin, it's his first time with our community, so thank you very much for spending your time on that. I'm going to kick it over to Sebastian to just kind of give an intro of what Vouch is about and their two backgrounds, and then we'll jump right into it. We like to keep things energetic, so if you have questions in the chat, if you want to post in the chat where you're coming in from, we'll see kind of what kind of audience we have, and the startup information, I might have to open that up. I just opened that up, so please feel free to throw your stuff into the chat. As always, we're recording this. We'll upload recordings to our YouTubes and distribute whatever Vouch gives us in terms of fund resources. I'm sure they'll have some perks for you and slides and all the various things like that they have. So without further ado, Sebastian, take us away.
Sounds great. Thanks so much for the intro, Ryan. Appreciate it. And excited to be here with everyone. I am dialing in from the West Coast in Pasadena. If anybody's familiar with the Rose Bowl, I live just a few minutes away from there. To get us started, I am our platform partnerships lead at Vouch. That is our partnerships network that typically helps startups or serves startups in a different way across the startup ecosystem. And I help to manage our partners and see where we can bring relevant content to reach our startup founders and clients that we like to typically work with. So, and then I'll pass it over to Devin real quick for an intro from his side.
Appreciate it, Sebastian. Hey, y'all. I'm Devin Wright. I'm an senior advisor here at Vouch. I'm dialing in. I don't know if anybody's familiar with the surface of the sun, but I'm dialing in from there. I live in New Orleans, Louisiana, so a little hot, a little toasty right now, but I'm very excited to be here and looking forward to the conversation with y'all.
Great. Thanks, Devin. And we have a presentation here. Let's just give us a second here to pull it up. And great to see a couple folks calling in from all over the world. Turkey, Ankara, one of my best friends is from Ankara. And the US Virgin Islands, great to see.
Really representing the Caribbean and Gulf area at the moment. Maybe
Exactly.
it's 90 something in New Jersey right now and humid as can be. So maybe we're all just united in our own heat and humidity.
Exactly. Cool. Hopefully everyone can see my screen now. So here's what we're going to chat about today. We'll probably take a good amount of the hour that we have scheduled. So kind of went through some introductions already. We'll talk a little bit about risk management and mitigation and how you can think about how insurance fits into that overall equation. We'll talk about why insurance matters, like why do so few first-time founders get insurance and why do so many second-time founders do it? And we'll talk about when insurance matters. What are those milestones you should look out for? You can really get in front of the 8 ball for a lot of reasons why insurance comes up, and it's just going to make you feel a lot more comfortable and make some of your clients, your investors, and others that are other stakeholders involved with your company feel better about you as a founder when you are knowledgeable about these subjects going into them. And then, of course, feel free to ask questions throughout. We'll try to either answer them in chat or if they're relevant to the topic, we'll try to touch on them during the presentation, and then we'll have some dedicated time at the end to go through any questions that are lingering. So without further ado, regardless of what risk type you have, whether it be getting hacked and having sensitive data you have exposed, or having an employee of yours slip and fall and have something happen, or a visitor to your store come in and have something happen to them. All of those different types of risks have different types of ways to manage them. And we generally think about it in the insurance world of looking at it based on the severity of the risk and the frequency of which it might come up. So looking through across the chart here, you can see that if it's low frequency and low severity, you might accept that the risk might happen. If it's high frequency but low severity, you might put in a mitigation strategy, policies or procedures. If it's high frequency and high severity, you might avoid that completely and just avoid touching that area. Maybe that's not doing business in a certain state, or not having a certain product feature that might lead to fires or something along those lines. But you might have a low frequency event that has a really bad severity. Say you fire an employee and they turn around and say that you were harassing them, or it was anti-discriminatory. That's probably something that hopefully doesn't happen very often for most of us. But when it does, or if that kind of suit comes up, you want to be able to transfer that risk. And that's exactly what buying insurance is. So go a little bit more into detail on the next slide. And I talked a little bit about how these different strategies could come into play with your individual situation. Say cyber is your biggest risk, and that would be like getting hacked and having your sensitive data exposed and through a hack. And we've all seen that come up in the news and happen to companies that we know and are familiar with. But you're exposed as potentially having customer data on hand. And so looking at our frequency and severity chart, you can accept it and hope nothing bad happens. Maybe you just don't get hacked. Maybe you're not a big enough target to get hacked. You could mitigate it, implement a cybersecurity strategy, partner or work with a cybersecurity solution. You could avoid it and not operate digitally. I think most of us know that that's not possible in the current construct of the world and specifically to our businesses. Or you can transfer that, and that would be buying cyber insurance, that have someone that will be a backstop for you to take care of the legal fees that come with any cyber suit, any potential judgments that come against you or lawsuits that happen. And Devin's going to touch a little bit more on that area as we get further into the presentation. So as I mentioned, we see that almost no first-time founders buy any type of insurance at the beginning of their company's journey. And that's probably for a couple of reasons. One, like there's no need. Usually insurance is based on, is purchased when founders typically need it. That could be like when they sign an office lease or when they sign a first customer contract that requires it. But we see that experienced founders, second, third, fourth time founders, buy it at incorporation 2/3 of the time. And that's typically because they've seen and been through those risks before. They've seen all of the random shit that comes up that just you can't foresee. And most of second time founders end up purchasing insurance very early on in their journeys. So you might be asking yourself, what types of insurance are actually relevant? And so we tend to look at it by stage of company. So early stage companies would be on the bottom of this chart. So at formation, you're thinking about formation paperwork and possibly a lease or hiring a first employee or contractor. There are different types of insurance that goes along with each of those, but generally at the beginning stage, you're looking at a few $100s per year of premiums to insure yourself against some of those early risks. At launch, so launching a product, getting investors, you're now maybe having customer data on hand. The cost increases, and obviously the types of coverage that you need also typically increase. Going further along the customer or the journey of a company, once you're raising, that brings in a different type of insurance. Directors and officers might be one that you might be familiar with, or errors and omissions as you launch a product in market. That will always, of course, increase the amount that you're spending on insurance, and because the risks are that much higher to you at that point in the journey. And then as you start growing and scaling and maybe go on to second rounds of funding or additional product lines and hiring larger teams, all of those things, we look at scaling companies and the needs that they have. obviously increasing price up to, in the tens of thousands of dollars per year in premium. But that's just because, the limits that you need are higher at that point. The amount of data you have is higher. So Devin's going to go into a few of these different areas specifically and what sorts of milestones you should be looking out for, and give you a little bit more information in your tool belt as you go and seek to understand more about your typical situation, what you should be looking out for.
Before you move on, Sebastian, we got a relevant question in the chat. There's a color coding here on this chart. And what does third-party company push event mean versus passive insurance need change?
So it's typically driven from a third party. So like a office space would require a need for general liability insurance, a contractual requirement from you're about to sign your first enterprise contract. They require cyber insurance before signing a contract with you. You're going to need to produce a certificate of insurance for cyber, in pretty short order. And that's going to be something that you're going to want to get in place very quickly. And as I was kind of alluding to before, if you go into those conversations and you understand that cyber is going to be a requirement, you can help your sales folks, and you're not the salesperson yourself, to be more well prepared. You can help your enterprise customer be more confident in your process and that you've been here before, when you don't gasp and say, wait, I needed cyber insurance, when you go into that contractual conversation. We've even seen in certain cases, and even with our own contracts, that if you give your customers a lot of confidence, they may say, hey, just show us that by the end of your first month of your contract and we should be all right. They might look past the actual certificate of insurance and give you a little bit more time to do so when they feel comfortable with your experience in dealing with it. So knowing the ins and outs of what might be required of you at these different milestones is going to help prepare you and give your other partners and clients a lot more confidence in you as the founder.
And this is very similar to compliance. I think the dark boxes are things you will run into as something external tries to happen, right? You try to land a customer and they're like, we're contractually, or we're a big customer. We do not, do business with people unless they have this much cyber insurance or something like that. And often this is where first time founders stumble, because they're like, oh crap, the amount of times I've heard founders be like, oh my God, we almost landed our first enterprise customer. And they're like, oh, by the way, you have SOC 2 coverage, right? And they're like, and then they run and do the thing. The same thing goes with insurance. And I will say, from our wheelhouse, the green is like evolving needs. Formation paperwork is something that we cover quite a bit. So when we incorporate companies with Gust Launch, we file their articles of incorporation with Delaware. Those contain liability coverages on them. So if you're just two co-founders or one founder, you make an LLC if you're more of a services company, but if you're a high growth startup, you usually file a C Corp, and you have decent coverage there for you and your founder to just start working together. You don't need to go and buy a bunch of D&O insurance or like slip and fall insurance if you're working out of your own living room. The only person to sue you is you. However, as your company starts to grow and capture value and things like that, eventually just the liability articles on your certificate of incorporation are not going to give you sufficient confidence that you are covered for additional formation stuff. Like, what if one of your directors or officers, makes a really big mistake and causes like a huge amount of damage? Like, just because your COI says you're limited from personal liability doesn't necessarily mean the company doesn't have any sort of backing or insurance or protections. So at each phase of your company, those green boxes can get more complicated. We often call it the layers of protection. The longer a startup sticks around, the more value it creates, the more layers you're going to want to protect you from greater and greater potential losses. And I'm going to say I don't know if you hear it in the background, but we have the tropical storm moving up on us. So it is supposed to be a rather wild night. If I get disconnected from this, I'm hoping Sebastian or Devin will be able to maintain it, because I believe one of you are at least an alternative host, is not a panelist. But if everything goes dark, it is because the Northeast has lost power.
We'll pray for you if you go dark, Ryan. All right, great. And just to call this out, we're going to talk a lot about specifics here and give you a lot of examples that are helpful, but it's rarely cut and dry. Your domicile or the location of where it happens matters. All the circumstances are taken into account. And at Vouch, we have in-house claims directors who are going to look at your situation and try our best to make everything covered where we can legally cover you. And try and get your claim solved. And that's one thing that is unique about in the insurance landscape is that you're buying a product that you hope to never use. And when you do need to use it, the insurers and you are somewhat at odds with each other because insurers make more money when they don't pay out claims. And that's not how Vouch approaches our business. If you could be covered for a claim, we absolutely want to cover it and make it as easy and seamless as a process for you to be covered. Just wanted to call that out and before we talk a lot about specifics. Cool. And I will hand it over to Devin to talk a little bit about, the incorporation and these other milestones that we kind of touched on in the prior slide.
Getting myself set up here. I hope everybody can see the screen here okay. So, as Sebastian alluded to, insurance kind of is a little bit about different stages. So as the company starts to grow, your insurance program and your risk profile is going to grow as well. So these next few slides here are just going to kind of walk you through a little bit of like step one here, all the way through, kind of one of the larger steps within the process of company scaling and growth. We refer to it about as your milestones. So typically, how this looks here is companies just getting off the ground. We're talking about incorporation. Now it's time to start looking around maybe at something like an office space. Maybe you're going to get into a co-working space. You're going to start purchasing property as it relates to the business, whether that's laptops, desks, chairs, computers, things of that nature. So we're going to kind of touch on a few of those kind of insurance basics here in these next couple of slides. So again, what we're referring to here is a general liability policy. These are very basic policies that are designed more for the protection of third parties. So really quick in insurance, there is 3 different parties. There is the first party, which is you, the client, the holder of the insurance policy. There is the second, which is the insurance provider. Third policy is anybody outside of that. Typically, a general liability policy at its basis was kind of used more as a coverage for offices or restaurants or storefronts in order to protect against potential slip and falls and bodily injuries from guests, things of that nature coming into the building and slipping, falling, hurting themselves, or if you have an actual product, bodily injury associated with that product. Again, this is typically required by a landlord, or it's going to be required by a bank in order to get a loan, or maybe even some of your customers are going to ask, hey, at the very least, do you have a general liability policy? Again, this is just kind of at the core and at the basis of a insurance program. Typically, these things are, a few $100s to maybe the low 4 figures. This is all in the industry kind of rated differently. So the premiums generally are associated with a handful of things within insurance. A lot of times it's what you call your risk profile. For general liability, your risk profile is based on what is the product you're offering, what is your expected revenue over the next 12 months, and in some cases, what is the state that you're located in as it applies to state mandated minimum premium costs. So for example, California has a different minimum premium for general liability than say Texas or New York or Illinois, et cetera. So those are going to be the factors that are going to go kind of into the pricing of your general liability coverage. So again, typical claims that you may see that are associated with the general liability policy. You have a client that is coming in to visit you at your co-working space. They slip, they fall, they hurt themselves, and they need to, potentially go get a broken arm checked out, a sprained wrist, bump on the head, something along those lines. These costs are going to be associated with the GL policy, which will help if they do bring a claim against the building owner, which is then going to get transferred on to you, since again, the client was there to see you. For those of you or those people who are manufacturing actual devices, for example, If the device is being handheld and it heats up and it burns a client's hand, or in the unfortunate case that maybe it starts a fire within the home or something along those lines, your product's liability coverage is going to be there to help with costs associated with those claims. Within general liability, there are a few other coverages that are included. Business property is one of those coverages. At its basic, this is just, as I mentioned before, coverage that's going to be associated with things like your laptops, your smartphones, furniture, desks, chairs, computers, things of that nature. Again, this is going to usually fall as a requirement by landlords or by banks, something along those lines. Especially now within the remote working environment, this is something that is much more important, I think, to our startup clients. Many general liability policies, Vouch included, do provide coverage for your business personal property as it relates to co-working or work from home spaces, so that if you are based in California and you've got an employee in Utah, or you are traveling to New Jersey, to go visit Ryan after the hurricane or something like that, you will have coverage potentially there if the laptop is lost, stolen, you leave it on a train, something along those lines, or even if there is vandalism to the home at which you're based out of, and your business personal property is taken from you. So again, it's a nice component to it. It is a lot easier than something like Apple Care or some of the other kind of basic property insurance policies out there. So again, a couple other examples here. Stolen goods. If you're in a co-working space and somebody, a bad actor comes in there and steals the laptop, or again, a thunder or lightning storm strikes, power surge causes an issue with some hardware or something along those lines there, you're going to have coverage for that with your business personal property claim. So let's move to employees. The next stage of growth, right, is now you are up and running a little bit, and now it's time to start hiring. Some big key topics when we're talking about employees are things like non-compliance fines. We do see a higher frequency now of claims associated with employment and things of that nature. So the two coverages we're going to talk about are workers' compensation and employment practices liability. It's important to distinguish these two coverages as they are not the same. Workers' compensation. This is going to be a requirement in all 50 states. It is important to know as well that if you are in a place like New York or Ohio or one of the Dakotas, I think it's South Dakota, this is a monopolistic coverage, meaning you will have to purchase it from the state program. All other states allow you to purchase it via a third party. A quick note on that, if you have a payroll provider of some kind, workers' comp is typically something that they can provide for you. The reason for that is they already have the information in place, which is the address of the employees and what their payroll numbers are. That is how workers' comp coverage gets priced or rated. The coverage itself is designed to cover for physical injury to your employees while in the everyday kind of doings of their business. So if you, again, have an employee go into the back of the mailroom to go get some boxes and they pull their back or something along those lines, workers' comp is there to help with the bills associated with missed time from work and potential medical bills.
Hey, Devin. One sec. We have one or two questions in the chat that might be helpful to answer. Maybe so for the first one from for workers' comp, do they need to buy from like a Vouch, or do they need to buy in each state that they do business in, or from a single state?
That is a great question. And as we alluded to a little bit, none of this is like totally clear. Now, as I mentioned before, if you have an employee in Ohio, you will have to purchase coverage for that employee in Ohio, since it is a monopolistic state. You can purchase the coverage itself for all other employees, either through your payroll provider, again, who can help set up a program for you, or through another workers' comp provider, another insurance agency that can be able to help you out. At Vouch, we do not yet offer that coverage. We do have partnerships with a number of carriers that we can help you get that coverage. And again, you have the ability, if you have a payroll provider, to see coverage through that option as well.
And then Devin, one other question that came in that might be, I figure other folks might be interested in this one too, is business property in addition to the cost of general liability or rolled into the cost of general liability?
That is a great question. That is dependent on the carrier itself. At Vouch, we include it within the cost, depending on what your limit is. So you do have the ability to choose your business property limit. Say it's $10,000 or $20,000. That coverage is usually kind of baked in. It's not really going to affect your premium as you move forward and start to increase that and buy more toys for your company. That can change. But again, it's dependent on the carrier. We include it within our general liability policy. There will be premium associated with it depending on the limit that you purchase. Just kind of keep in mind the higher limit that you go, a little bit more cost is going to be associated with your coverage.
Thanks.
Cool. I'll move through this and skip to employment practices liability. This is a coverage that we are seeing as becoming more and more important. And again, similar to workers' comp, is going to be state dependent in regards to the frequency and severity of claims. At its basis, employment practices liability is kind of good to look at as employee on employee issues. We're talking about harassment, potentially wrongful terminations if you are letting an employee go, discriminations in hiring or firing practices, things of that nature. It is important for companies to start to look at carrying as maybe you receive a round in funding and you're going to start hiring. At Vouch, we typically recommend picking up the coverage maybe around employee 5, 6, or 7, depending what state you're in. The reason why I keep emphasizing the state is states like California they essentially provide 20% of all employment practices claims in the country, with 30% of the associated premiums or claims payouts through the coverage. So the frequency in California of finding a wrongdoing against a company is extremely high as compared to other states, which is why maybe employee number 3 or 4, you start to look at that as compared to other states. The severity of this, and unfortunately the growing frequency of claims that we see come in, especially in a very litigious country like the US, employment practices starts to get very important as you start to grow the business. Just a couple of quick ones here in regards to some of the potential claims that you might see that may affect your employment practices policy. I'll just give it a sec here for y'all to kind of check out.
Hey, Devin, we had a couple questions come in on employment practices liability. So the first one was from Anne, and she asks, do employment practices liability insurance cover contractors or just employees? And then expanding, Scott was curious about what about Canada or Europe? I think those answers might go hand in hand.
Yes, they do. Both great questions there. So employment practices liability is really designed for your full-time W-2 type of employees. There are some cases where contractors may be covered in that, but I would say that 9 times out of 10, it's going to be designed more towards your full-time employees. In regards to other countries and things like that, it is going to be country specific. So if you have employees in Canada or somewhere else within the world, I would strongly recommend that you look up their employment laws there, and will probably need to purchase the coverage through a local agent if needed. Similar to general liability and workers' comp and employment practices liability, if you are within a U.S. territory, and I know we've got some international folks on here, this is going to be kind of the same for you as well. Most of these coverages when it regards to injured third parties are going to be within the coverage territory that your insurance provider is domiciled. So if your insurance provider is in the US, the coverage itself is typically only going to be in effect or active for US-based employees or incidents. Now, we will get to some other coverages later that are a little bit different. But again, for right now, these initial coverages are typically all, I guess, more domiciled or localized within the nature of your coverage territory and the claims associated with it.
Great. And Devin, couple other questions came up around EPLI. It's obviously very compelling for the whole group, which is awesome. If you don't mind taking it back one slide, Kai asked for a explanation of the table that's on the last slide. So it is, yeah. So like maybe talk about what if you could just break down the table a little bit.
Yeah, absolutely. Again, kind of similar to the frequency and severity table, this is simply just kind of a table that is suggesting limits for limits as they relate to full-time employees. So again, California, New York, Illinois, extremely litigious states when it comes to employment practices liability. So as you start to add employees, we are kind of suggesting that you look at increasing those limits a little faster than maybe if you're operating within other states. So again, as you start to grow and you're on employees 1 through 25, $1 million in limit is probably a great place to start. After you get to 26 to 50, again, depending on where you are, you're going to want to look at potentially increasing the limits as you move forward.
Great. And then last, I think, EPL question that I've seen come in is about from Clifford, and he's asking about subcontractors. He's in the construction business or contracting and building management business. So for subcontractors that they partner with, would any of their employees be covered under EPLI?
So typically subs are going to get picked up under a GC program. I think in construction, it operates a little bit differently just because of the nature of the business. Typically the sub is going to need to have the coverage, but you will ask your general contractor to make sure that they are carrying an employment practices liability policy. And then the subcontractor would get added as a named insured onto the policy. This is where things start getting a little bit complex here. Essentially, a named insured would mean that the subcontractor would be privy to the coverages of the general contractor as it relates to whichever policy they are getting included on as a named insured. Cannot stress this enough. I did a little bit of construction work back in my old days when I lived out in San Francisco. It is very important to make sure that all subs have coverage for workers' comp and employment practices, general liability moving forward. That's kind of more designed for you there, Clifford. But important to make sure that you review their insurance programs. Simply ask them for a certificate of insurance before moving forward with any negotiations.
Cool. And then, you know what, Anne asked for one clarification so that you talked about full-time and part-time employees a little bit. I think we talked a little bit more about full-time. Are part-time employees who they don't pay benefits for included in this calculation?
Part-time employees typically are not going to be included or even privy to employment practices liability coverage. Just because the nature of the hiring and kind of like contractual basis on which they're working on, it just doesn't quite work as well. Some carriers may provide that, but typically you don't see contractors as privy to the nature of the coverage there because now you're talking about contractual violations. If you're releasing a contractor for subpar work or something along those lines early from their contract, it's just that the nature of that kind of release is going to be a little bit different than the release of a full-time employee. So you really want to make sure that within the contractual language that you have with contractors and outside party hirings that you have, this very clearly defined section of what happens if you need to release that subcontractor for any reason whatsoever. The other component with contractors typically is that they're going to get paid through the life of the contract no matter what, unless it's a certain incident that takes place that negates their payout. So it's not quite as litigious for them. They get let go. They're still getting paid conceivably. They're not really worried about it. Full-time employees, obviously, it's a little bit different because they're being paid a salary, being let go, and now all of a sudden, things have changed for them from a financial standpoint. So it's kind of the key difference there within the coverages.
Cool. Thanks, Evan.
Mm-hmm. All right. Moving forward into this next section here, now what we're doing is we're kind of going to focus on some of the coverages that are going to be associated with incidents that stem from your customers. You have made it. You have grown your business. You've got your employees. You're working through the process now of getting customers on board. Maybe your product is about to go live or something along those lines. And now it's time to start thinking about the risk profile of your business as it relates to the effect it may have on your customers. Typically, this is going to be from a financial standpoint. Again, general liability, we're talking about that products liability thing and bodily injury to your clients or your customers. Now we're moving forward into something that's going to be a little more financially related, or in some cases, data related as well. Errors and omissions. This is very important. Typically within the insurance industry, errors and omissions and cyber coverage are going to be packaged together as one, because a lot of the times the claims associated with errors and omissions can be related to cyber incidents as well. At its basis, errors and omissions is like a professional liability policy. Doctors, lawyers, financial advisors all carry professional liability policies, which means that they are providing service or advice that their clients follow, and in some cases could suffer some kind of financial or physical harm. Errors and omissions is going to be the same in that nature, and that you are providing your clients a service, whether that's for a fee or for an expected outcome that may affect them financially. The difference with errors and omissions is that it is also going to include errors and omissions that affect or stem from your tech. So if we are talking about an algorithmic error for a fintech company in which provides advice to your clients for them to follow for some kind of financial gain of some kind, that can be an error, a tech E&O. Or if there is a coding error that results in some sort of incident or shutdown on your system, that now your clients can't access what they need in order to operate on a daily basis. Again, an error and omission as it relates to technology. I'm always blanking on the name of the company that just had that software update that led to that massive cyber incident affecting a lot of the airlines. That is a great example of a tech E&O type of claim. So just kind of keep that kind of component in mind moving forward. Again, why it matters. This is typically when you start getting into contractual negotiations to bring on a client, they are going to ask, do you have this coverage? Or they're going to say, we are not getting involved until you pick up this type of policy. So again, this is something that is typically going to come either when your product is going live, or you're going to get asked to carry it from an enterprise contract, or potentially even, if you're doing some fundraising or something along those lines. Again, this all varies by category. In terms of the costs associated with it. The higher the risk profile, the higher the cost is going to be. If you are operating in fintech or healthcare, your costs are probably going to be very different than if you are operating a SaaS type of business or something along those lines. Again, we're starting to see the rates along with cyber liability increase a little bit. What we refer to in the industry as capacity, which means the limits that carriers are willing to offer on the coverage, carriers are starting to pull back a little bit. Whereas maybe last year they were willing to offer you $10 million of coverage. This year, maybe they're only willing to offer you $5 million, something along those lines. Really quick to touch on the table here. Again, just kind of a loose kind of look at if you're a B2B type of company versus a B2C, just a little bit different in terms of either number of big contracts or revenue within your business, what you should start looking at from a limit standpoint. Cyber liability, again, kind of goes hand in hand with errors and omissions. And as I mentioned about that, the software update that affected the airline industry there, that error created a massive cyber incident for a lot of its clients and customers. So now you're talking about a two-pronged type of claim. Cyber liability, for all of you watching, is kind of what it sounds like in your head. We are helping. This is going to be associated with the costs for data breaches, ransomware attacks, phishing attacks, third-party business interruption or first-party business interruption. If you're not able to access your system due to some type of incident or cyber hack, which slows down either yours or your vendors or your third party, your clients or customers, there could be costs obviously associated with that. A big one that a lot of people, I think, kind of tend to overlook is that if there is a cyber incident on your system, you need to notify every client that you have of a data breach. Each state is very different with how they do that. Typically, you need to hire a third party to do that. The costs associated with that typically are included within your cyber liability policy as well. Again, the variance for this kind of thing is very different depending on, one, the amount of data you are collecting, and two, the type of business that you are. Again, fintech and healthcare companies collecting that kind of data is going to be a little bit different than some other ones. I do want to note as well that even if you are passing on data to a third-party vendor like AWS or something along those lines, it's still going to be important for you to carry this because you still need to do the pass on. And typically, if there is an incident that takes place on that third-party vendor side, you're going to get named in the lawsuit because your client data was something that you pushed to them. Again, your clients are looking at you to make sure that their data is safe however you store it. They feel that for however you stored it wasn't safe or the best way that you could have stored it, you're going to look at a potential suit and liability in that arena.
Hey, Devin. We have a couple of questions from the chat about cost for errors and omissions and obviously related cyber. So I know it's going to be it depends answer big time on this, but can you give like a rough range or cost for maybe some of the smaller end premiums for cyber and E&O?
Yeah, sure. Typically, depending on if you're just starting out and maybe you're collecting less than, I don't know, maybe, 500,000 points of data or something along those lines, depending on how you group that, a cyber liability and maybe an E&O is going to cost you, maybe $1,000 each or something along those lines. As that starts to build up, that is going to start to change, obviously, once you start exceeding and getting into the millions of data points, again, depending on how you're collecting them, whether it's, name, address, number, that is one thing. If you're counting that as a single data point or you're counting that as three, again, that question is going to come up on the application. So that is fine there. Now, if you are collecting financials, if you're collecting Social Security, those three data points are going to be more expensive. So a great way to look at it is there's like the cheap data, the standard data that anybody can find. And then there's like the expensive data, which is the stuff that's more privatized to an individual or to a business. I want to point out here as well, too, that cyber liability isn't just associated with your client's data. This is your data as well. All of the effort and time you have put into your business and all the financials and everything that you have on the back end, cyber liability is also there to cover incidents as it relates to your data as well. So it's important to get this coverage in order to protect against any potential issues that may come up there.
Super helpful. And I want to point out one other thing that might impact pricing for cyber and E&O, which is whether you have a SOC 2 certificate or not. If you do have one, typically insurers, Vouch included, will ask if you have a SOC 2, and that can impact pricing positively for customers.
That is correct. Same thing, just to reiterate that a little bit more, anything that you're doing to put risk mitigation practices in place, all carriers are going to love to hear about it. The more information you can provide them, the better. This is, like, a storefront that puts in non-slip maps on the entryway to their store. Anything that you're doing to mitigate the risk associated with the business, make sure that they all know that so that you can get the best pricing possible. Cool. Again, a couple of examples of cyber or errors and omissions incidents that may take place. You've got your hacking, which is something that is obviously on top of mind. I did actually really like this batch streaming service here kind of thing. So that if you're a company that's providing a streaming service, let's say for a concert or something along those lines, you just did Lollapalooza or Outside Lands and you're streaming it, people are paying in order to be able to watch it, and you have some kind of coding interruption or something along those lines that knocks down the streaming, clients that paid for the stream service are going to be upset, as is the business that you promised you would stream the service for as well. So these are two really great examples of both cyber and E&O claims. And then just a really quick overlay of some other common coverages. Typically, as you start to grow and businesses start to get a little bit more complex within their risk profile. Directors and officers coverage. This is going to be associated with companies who maybe are now getting a formal board in place or starting to look for fundraising from venture capital groups. They're going to ask you to carry this coverage. The coverage is designed to protect investors into the business as well as the executives of the company, board advisors, C-suite employees, directors, officers, investors, etc. The coverage is designed to both protect the personal assets of its founders as well as the company assets as well. So what I'm talking about here is, as your company starts to grow and you're starting to get a little bit more complex in the everyday decisions of the business, you need something that's going to be there to protect against kind of these bigger and bigger decisions your company is making. How are you going to allocate resources and funds? If you misallocate those things to a certain degree, there could be lawsuits that stem from your founders or in-house board or something along those lines. If you are operating in a highly regulated industry and you violate industry standards or regulations, there could be a suit brought against you, again, from something like the SEC or something along those lines. If you are violating company bylaws in any way, there could be a suit brought against you as an individual from your own company. Directors and officers is there to help with those types of associated claims. Crime coverage, similar to and typically related to the growth of your company, as it not only comes from a fundraising standpoint, but also from a employee growth standpoint. Crime is designed to help protect against bad actors within your business that may be handling some of the financials or some of the transfers. Startup community gets a lot of money to handle and to move around and to allocate to different things. Crime coverage is important to help protect against somebody potentially out there, acting with bad intentions. Hire non-owned auto is something that's typically going to be required, typically from a landlord or something along those lines. This is designed to protect, it's kind of tied into your general liability policy. Again, if you're traveling on business or you're an employee-owned vehicle doing the everyday things of your business, whether you got to go visit a client somewhere or you're out pushing product to some type of event or something along those lines. This can help with the costs associated for accidents when traveling on business. Yes, rental cars can be included within this. And then fiduciary and employee benefits liability. As the company starts to grow and now you start operating as a fiduciary, distributing benefits plans to your employees, whether that's a 401k, health, dental, vision, things of that nature. Benefits liability is there to help with the costs associated with the mismanagement of those. If you forget to enroll an employee right away in their 401k, or they said that they wanted to put 10% into the fund and you only put 5, or if you didn't enroll an employee spouse onto their benefits program, and something happens to the spouse, those kind of mistakes could bring a lawsuit. That is what these coverages are there and designed to help with. And then the final one here, media liability. If you are creating content, whether that's on social media, podcasts, anything of that nature, media liability is going to be important for you to have out there, just for protection against things like libel, slander, potential IP infringement, something along those lines.
No questions in the chat, Devin?
Cool.
I can take this.
Great. Yeah, good.
Awesome. I've been I just shot a message in the chat here in response to Suzette. Wait, let me present that real quick. Sorry, just give me 1 second here. Great. So I've been messaging in the chat a little bit about this, but we have a couple of resources for you. I think, a few folks have reached out about their specific situation, their domicile, et cetera. I think for those specifics, I think with this larger group, we don't want to go through too much individuals, but you can reach out to Devin or I. My email's right here, and I'd be happy to pass you along to Devin. His devin.wright@vouch.us. You can reach out with specific questions there. The best and most accurate way for us and any insurance advisor on the team to be able to give you specific advice is by applying through vouch.us/gust. That is the best way for us to get all the details that we need to give you an accurate assessment of price and options and advise around your coverage program. So the best way to do that is going through that link, vouch.us/gust. You can apply through there and get a 5% discount. Typically that is a little bit dependent on exactly what states you're in, but in most states that's applicable, in most products it's applicable, and that discount actually goes in perpetuity. So if you come back and renew for year 2, that same discount will be applied. So it's a really great benefit. We also have a number of other resources, and they're linked here in this presentation, but I will follow up, 1 with the presentation, 2 with some of these resources and links to them. So we have a blog on our website that goes into other 101 type of material, California employment practices conversation, and some of the other topics that we've touched on today. We have a milestones guide that helps give further detail from what we talked about today, cyber coverage, E&O, and then a risk assessment tool where we can help to advise around what types of coverages are possibly relevant to you, and then also the amount of premiums that might, or the amount of coverage and limits that would apply to you. That should take only a couple minutes to fill out, and a link is here in this presentation. And so those are some of the resources that we recommend as a good first step, especially in working with Vouch. Great. And then this is the end of the content, but just wanted to ask about if there's any other questions. I see Sherry has one more question about performance of product issues. So I don't know if there's more detail to that, Sherry, or if you want to type in the chat, I can help call it out. And then we're getting some AI summaries as well, which is also very helpful to get that follow up and distill all the information we've got. Anybody else, feel free to reach out with any other questions in the chat. Otherwise, I think we can wrap up here. Oh, okay. Sherry's saying that the questions about if what constitutes what's covered with product liability if the customer says that the product doesn't do what it say it does. So maybe Devin, you can tackle like how the product liability coverage might apply in this situation and what maybe a claims advisor would help to understand or help to clarify around the situation to understand whether it's a covered claim or not.
Yeah, I mean, typically product liability, as it relates to a general liability policy, is something like bodily injury or something along those lines. If the product simply isn't working, that kind of falls into a little bit of a gray area. If it's not working because of an issue with the manufacturer, you are hiring a company to do the manufacturing of the product for you. That's probably going to fall more under into an issue for your manufacturer, which again, important to make sure that if you are producing a physical product, that you make sure that your manufacturer has coverage and has a good record with this and has a clean loss history. Just like with anything else, any claim, there's just going to be an investigation into it. So if a client comes back and they say, hey, this didn't do what it was advertised to do, if that's a one-off type of thing, typically there's ways to mitigate that risk through the refund of a product or something along those lines, or, a refund for the damaged product. Now, if it's something where you start building up and there's more and more of this, that's, again, going to be a little bit different. And again, your insurance provider is probably just going to dig further into what that is. Their claims team is going to get involved to find out where this product issue stems from. Is it the client not using it correctly, or is it an actual manufacturing problem that results in kind of a lemon, so to speak? And then you're talking about recall coverage, which again is going to be included within your product liability policy.
Cool. That was helpful. And then we have two other call outs. So one is I've gotten a couple questions about who Vouch covers. Devin, do you want to maybe distill that into like who's within Vouch's universe?
Sure. Vouch is typically designed for the tech and startup community. We are, every insurance carrier kind of has a different what we call risk appetite. So, B2B, B2C SaaS companies, healthcare data providers, payment processors, things like that typically fall within kind of our wheelhouse of what we're looking for from a client standpoint. We're looking for something that's just a little out of the different, again, a company that's just kind of starting up, getting off the ground, looking for their first kind of line of coverage or something like that. E-commerce will fall under this. That is yes.
And one other question that came through just around venture-backed startups. We cover venture-backed startups for sure, but also all types of different funded companies, self-funded, friends and family, seed. There's many different types of funding levels that we deal with. So generally, the bigger designation that we deal with is technology-based companies and not the type of funding that they go through. And then, Devin, there was one other question real quick before we jump about whether a part-time employee is covered under EPLI, not contracted.
Part-time employees generally aren't going to be included within there. Again, depending on the carrier, you might. It's always good within the application, you're going to state that you have a part-time employee, but typically employment practices is going to be designed for 40-hour work week type of employees. But it is always good to speak with your agent or to the carrier about that, because again, all carriers can be a little bit different.
Perfect. Thank you to everyone who joined today. Hopefully you guys found it very compelling. And if you have any follow-up questions about insurance or your specific company, feel free to reach out directly to me or Devin, and we'll be following up with a couple of these resources. Thanks so much.